Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, Indian equities brace for Middle East violence effectively. GIFT Nifty indicates a gap down start coming in for Dalal Street. US market ended higher thanks to hot job data. September US jobs report raised the stakes for inflation figures later in the week. US stock futures slip. Oil and treasuries surge on Middle East violence, and if you talk about oil prices, they've almost jumped around 3 to 4% on the hostilities around the conflict. Perhaps bonds have fallen to most in over a year on RBI's debt sales. And if you talk about Asian shares, they've been trading mixed in early deals on Monday. Talk about FIIs, they've offloaded equities to an extent of 90 odd crore. That's a minuscule amount that we're looking at. And DIIs, they've purchased equities to an amount of around 783 odd crore. FII, let's look at the activity in the F&O space. Well, at least some solace coming in on that front. FIIs have been the net buyers in index futures, in index options, in stock futures, and in Bank Nifty options. The only place where they've been sellers to an amount of 30 crore is Bank Nifty futures. So that's one space that you got to watch out for. But if you look at the ban, F&O ban, and the stocks that are there, in new in ban, there is no stock, but perhaps it has been added into the category. And what still remains in the ban is Delta Corp, Manappuram Finance, Indiabull Housing Finance, PNB. Let's also talk about option queues. Well, Nifty PCR right now is at 1.12 versus 1.13. Let's discuss this and more with the trade setup, the strategy for the day, along with few stock recommendations from Prashant Sawant, who is the founder of Catalyst Wealth. Morning there, Prashant.
Hey, good morning, Nickey, and good morning to all the viewers.
All right. Typically not a good setup that we're looking at, with the Middle East tensions perhaps now escalating for the markets across the globe. Do you think it's a good buying opportunity? What levels are you recommending both for Nifty as well as Bank Nifty?
So I'm following a very simple technical setup for the week, which is we happen to close on Friday just above the major level of 19,650. Today we are looking at an opening somewhere in the range of 19,540. So I would wait for another close above 19,650 spot. If it happens today or tomorrow, that would be my entry, and my low would be my stop loss would be 19,500. It's a crucial level, a make or break level in terms of spot. So it would be like 130 point risk on Nifty. From there, I have straight look at targets around 19,850, which would be like a 200 point reward. So for me, a close above 19,650 is very important. And my suggestion would be not to get into any longs or shorts right at the opening. Wait for the first 1 hour for Nifty to settle down. And as I said, what matters most now is the close above Friday's high. I have a similar view on Bank Nifty. And I think one thing which stands out for the past 3-4 days is HDFC Bank, which was a complete laggard in terms of performance, which was underperforming, has picked up very well. A base is formed, and above 1560 levels, it might show a lot of strength. So from that perspective, I'm also tracking Bank Nifty for a close above 44,500 in spot. If that happens, we'll see another 500 point rally to 45,000. On a major support basis, 43,800 holds a lot of importance for Bank Nifty, just like 19,500 for Nifty.
Sure. At this point of time, especially for TCS and bets like that within the IT and the FMCG space, if that were perhaps the counters to hide in, what's your assessment on TCS and anything that you like from the IT defense space right now?
So I think one stock, TCS, I've been definitely tracking, but I think in the mid-cap IT, I think Birlasoft looks good. It might show good levels, but overall, currently, if you look at TCS, it is at a resistance of 3,630. So I would wait for it to pull down, and if I get it somewhere around 3,580, 590, I think that would be a good level to enter. But I think for this week, if the market stabilizes, IT may show a strong rally, and I'm definitely tracking Nifty IT as such, and looking at a good performance from Tech Mahindra, Infi, and TCS.
All right. Is there any... Okay, we're just going to address the market open and then come back to you, Prashant, in that case. Well, we are looking at a weak start coming in for Indian equity markets, 19,500 mark. That's been held on to 0.75% of losses early in morning for Indian equity markets. Well, it is a negative start coming in for Indian equity markets. just in line with what we were anticipating, a weak start. Whether this serves as a buying opportunity or not, we're just here to look into that. Whether it presents a good buying opportunity with the levels that we're working with, 19,500, are the valuations are attractive or not? We're going to be talking about that in just a bit. But let's also talk about Bank Nifty for you. At this point of time, is there a weakness which is essentially creeping into for Bank Nifty too? We are looking at sharp cuts coming in for Bank Nifty, almost close to 1% for Bank Nifty index, perhaps being weighed down. Let's look at something like an HDFC Bank. How is that stacking up? And also look at how PSU banks are faring on a day like this. HDFC Bank also is a bit under pressure. More than 3/4, close to 1% of losses coming in for HDFC Bank and PSU Bank. Look at that. Look at the sharp cuts for the PSU banking index. 2.5% down in early deals and opening trade. So that's a bit of worry for most of the investors out there. But let's also look at something in the likes of IT, the defense space, essentially after the buyback announcement or the plans of buyback is coming from the TCS. Mid-cap is doing well, a bit of stress coming in from the mid-caps, 1.5% of losses coming in for the mid-cap basket, and small cap acting no different, 1.5% of losses. More than that, severe losses coming in even for small cap index. So clearly large caps seem to be a bit insulated as compared to the broader index. Typical situations that plays out when there are geopolitical concerns. That's the reason why most of the people say that you have to allocate most of your equities in the large caps case for an event like this if you're an investor. But let's look at IT space right now. 0.25% of gains coming in for Nifty IT index right now. And if you look at something in likes of FMCG, Realty, Auto Index, Pharma for that matter, Pharma is down and out with losses to an extent of 0.75%. And in terms of other sectoral indices that we have on the list right now, FMCG is down and out with 0.5% of loss, and Realty, Auto and Banking for that matter also seeing losses to an extent of 1% coming in for the auto basket. And for banking index, we've already spoken about the cuts with the PSU as well as the Nifty banks. Realty index is acting no different, 0.75% of loss coming in for the Realty index too. Also, let's look at something in the likes of, let's look at the top gainers and the top losers before we deep dive into the stocks that one needs to watch out for in today's session. ONGC, HCL Tech, TCS, no surprise for guessing there. IT stocks have made it to the top gainers list. And if you also look at something in the likes of other top gainers that we have, well, there are just limited gainers at this point of time. Market breadth is just in the favor of declines. 44 declines as compared to 6 advances at this point of time. Perhaps the list is short at this point of time for the Nifty gainers. Let's also look at top losers that we have on the screen right now. Adani Ports is one of them. BPCL and Tata Steel. These are some of the top losers that we have. Adani Enterprises, UPL and NTPC. That's the typical market setup. Oil producers sitting at the top and you have the retailers as the losers. Clearly, one needs to look out at as what is the theme that could play out here on. But let's actually go back to Prashant and check with him something like an ONGC. How do the charts look like right now? Do you like the charts?
So I think, Nickey, in terms of ONGC, the opening is strong and a base is formed. So I think we are at a crucial level of 185. One can definitely create a position with a stop loss around 180. And I think we can go to levels around 190. But a major mode come only if we close above 190. Above that, we can look at levels around 195, 198 as well.
Right, that's the word coming in. But let's address some stocks to watch before we go back to Prashant and check with him any other query that we might have. But the list is rather long. But let's first talk about TCS, because that's the one which is perhaps going to be the biggest, perhaps the stock of the day. Let's just call it that way. It's already been in news from Friday, and the company is going to be considering a share buyback proposal on October 11. It's essentially going to be also announcing in the earnings on the similar day. Now, the TCS board will meet to consider the decision. And ahead of the buyback announcement, do bear in mind the fact that TCS shares have already ended near almost 1% higher on Friday. If you just talk about cash balances, cash on books, as of June 2023, TCS had a cash balance of roughly 15,622 crore. The IT major goes without saying is a debt-free company. It has launched its last share buyback back in year 2022, where the IT major bought back shares worth around 18,000 odd crore. Remains to be seen if it is way around that 16,000, 18,000 crore of size, and the price, of course, which also will dictate the trend here on. The last time that TCS announced it, the shares took a knocking and they were down and out substantially after the announcement came in. Reliance Industries, that's another one for you, where you have Abu Dhabi investment yet again coming in for Reliance Retail Ventures, which is a subsidiary, and the investment is to an extent of 4,966 crore. Now, it's valued really Reliance Retail Ventures at a pre-money equity value of around 8.38 lakh crore. And this investment by Abu Dhabi will translate into an equity stake of roughly 0.6% in Reliance Retail Ventures on a fully diluted basis. Now, do bear in mind the fact that the stock is also, Reliance right now is perhaps succumbed to some amount of selling pressure due to the concerns that we are witnessing. But right now, the stock is down and out in trade with losses to an extent of 0.75%. Let's look at Tata Company's update out there. First one is Titan Company, where it's come in with Q2 updates. Well, the stock isn't doing too well. Down and out with losses to an extent of 1%. The company has recorded in revenue growth of nearly 20% year on year for Q2. It's added in more 81 stores in Q2, taking the total retail presence to around 2,859 stores. If you look at the segment-wise breakup, well, the jewelry division has grown in by 19%, the watches has grown in by 32%, and the eye care segment has grown in by 12%. Along with that, CaratLane, the new acquisition, has grown in by 45% for the quarter on year basis. So that's a bit of positive coming in for Titan, but right now not reflecting in the sentiment overall for the company. Tata Steel, well, pretty dismal set of numbers that have been reported by the company. Talk about production, it is up by 4% at 4.9 year-on-year basis, but the delivery, or rather just say the sales volume, have come down by 1.8%. Even the European production volume, even in terms of production European market, it is down by 17%, and European delivery also has come down by 4.3% in the quarter. So not good set of numbers for Tata Steel. Clearly look at the drubbing which has come through for the company. Also got to do with the China sentiment and not just in isolation of the production numbers. Right now the stock is down and out with losses to an extent of 2.5%. Prestige Estate, another one that you need to look at. Total sales is good quarterly updates, I would say. But in a market like this, remains to be seen how stock like Prestige Estate can also do. Total sales is up by 69%. The collection is up by 13%. Overall, it's a good operational update coming in for the first half of the financial year. The company has registered record-breaking highest sales. Now, do remember the fact that, look at that, the stock is already up as much as 3% in early days in a weak market like that. On Thursday, CLSA had essentially come in with a report on Prestige Estate where they've raised the target price to 750, suggested that the channel checks were talking about strong response to the new launches in the quarter two, and believe that at this point of time, the company may also raise its guidance to around 160 billion for the entire financial year, which is already the highest pre-sale guidance amongst all Indian developers put together. Now, it also believes a significant discount to peers is unwarranted for the counter, but the valuation seemed to be a bit of attractive. Look at the counter right now. The stock is picking up momentum, 3.5% of uptake coming in on this one. So that's that. When it comes to the stocks and news that we have, clearly I'm going to go back to Prashant and check with him what does he make out of something like a Tata Steel, for that matter, metal companies. What does he like? Does he like anything from that space? And if yes, what are the charts looking like?
So I think, Nickey, in terms of metal, the strongest counter has been Jindal Steel. Even if I see today, the lows have been bought. It made a low somewhere in the region of 660, 665, but it has been bought. So I would avoid Tata Steel and I would go with the sectoral leader, which happens to be Jindal Steel. If anyone wants to buy, you need to have a stop loss of 655 spot closing. And I think from here, the stock may rally to levels around 700 once again.
Right, Prashant, we're just going to leave it at that. And thank you for taking out the time and speaking to us this morning. Well, perhaps a lot of ground needs to be covered on the fundamental side with regards to the Middle East tension that has come through for the Indian equity markets. What sort of bearing it will have on the equity markets? The knee-jerk reaction is pretty much seen on the screen right now. But to take the discussion forward, we're being joined by Hemang Jani, market expert, early in the morning to talk about the impact and the key monitorables of the development. Morning there.
Yeah, hi, good morning.
All right. How are you looking at the entire situation, the Middle East tension, which has apparently escalated to a point where all the asset classes have been impacted? Indian equity markets are perhaps feeling the heat too. With that in perspective, A, what is the key monitorable, and do you think it's a good buying opportunity?
Yeah, so basically, the overnight or the weekend development surely is a matter of concern because the scale of violence and disruption is very high. And what remains to be seen are two things. One is that what really happens to the crude oil price, because we have seen a knee-jerk reaction of about 4% kind of a spike. So if we have an escalation of tensions with more, countries getting involved into the conflict, then surely there is going to be a negative impact. Also, we have to see, in terms of the domestic cues, how the earnings season pans out, because TCS, as we all know, there's a buyback and there is going to be earnings that they will be announcing. So the entire earnings season, how it pans out, the early part of it is what is going to, decide the direction of the market, at least in the short run.
Okay, at this point of time, given the valuation that we're sitting at, of course, needless to say, Q2 earnings will also dictate the trend. But what's your assessment and expectation out of the earnings season? And do you think at this point of time, perhaps large caps now will be more in focus?
Valuations wise, we are quite okay at about 18.5 times next year, price earning multiple, which is okay. This quarter, again, the Nifty is likely to report a 21% kind of earning growth, which is good. Given that even last quarter, we had seen a very strong growth come through. And the large part of the earning is going to be driven by multiple sectors, unlike what we had seen where banking, financial services, auto, and very few sectors were contributing. This time it's going to be a little bit broad based. So I think not too much worried about the valuations or earnings per se. I think we are in a good spot, and we should try to buy into this decline, unless we see a big escalation. I think the market should stabilize and see a revival over the next few days and weeks.
So if it is a good opportunity to buy, what are the pockets essentially that you think look attractive to you at this given point of time? Do you think perhaps defensive space, something like an IT and FMCG combined put together, will look good?
You should look at buying into the names which have corrected more, or where the earnings, visibility is very high. So I think definitely banking, financial services, if we see any correction, should be a good opportunity to get into it. Apart from that, we also think that pharma and IT would provide a good stability to the portfolio, given the fact that they are considered defensive. Also, in case of pharma, we are seeing incremental positive data points in terms of price stability in US. A lot of approvals are coming through. The quarterly numbers some of these pharma companies will report are likely to be good. So I think these are the 2 or 3 pockets that we should be watching out for.
Sure. Hemang, I'd like to understand, do you think this event could be disruptor of sorts for Indian equity markets, or is just going to be one of the knee-jerk reaction and then markets will come back to their own fundamentals in anticipation to the earnings season, or for that matter, the FII trend which has been holding thus far, support coming in from DIIs? What's your assessment?
Well, if we don't see a major spread of the escalation where multiple countries are involved, or where you see the crude oil spike to about, let's say, $100 or beyond that, only then our market would kind of get a little perturbed, or you would see a question mark on the bull market rally that we are witnessing right now. But I think the early reaction is just some sort of a knee-jerk one, basically because of the uncertainty around that region and the scale of the violence which is there. So I personally do not think that there is going to be a significant escalation, though it may remain between the two countries as of now. So I think we should just wait out and watch how things unfold. And then if you see any meaningful correction, then should surely look to buy into it.
All right, Hemang, we're just going to leave it at that. And thank you for taking out the time early in morning to speak to us.
Much.
All right, let's also talk to the independent market expert Ajay Bagga, who will essentially give us an assessment of what does this mean for Indian equity markets and the key monitorables that one should be looking at. Ajay, good morning.
Good morning. Good morning, Nickey.
All right, your initial assessment of the knee-jerk reaction that has come through for the equity markets with regards to the Middle East tension thus far, almost all the asset classes seem to be impacted with this development. What's your initial assessment?
See, there is a flight to safety. So if you see dollar is up, they'll be buying of yen and Swiss franc, which are normally the safe haven places. Gold is up. Oil is up basically because of the fear of a supply disruption or a distribution disruption. In case Iran is called out for this attack as the chief planner, and if more sanctions are announced on Iran, Iran is supplying about 3.2 million barrels a day into the global pool. It has gone up by 600 to 700,000 barrels this year. And the U.S. has been soft on sanctions on Iran. Most of this oil is going to China. So if this, a conflict spreads out beyond an Israel-Palestine with Iran as a backer of the Palestinian terrorists, if it's limited to that, then we should see only a couple of days of reaction. If it spreads, then, all bets are off. But mostly what we see is that there will be an on-the-ground takeover of the Gaza, occupation of the Gaza Strip by the Israeli army, just like the condition was up till 2005. They will try to dismantle the Hamas presence on the ground. So expect that. There is a massing of about 100,000 Israeli army reservists on the Gaza border. So expect any action. And till some clarity emerges on that, I think markets will be a bit roiled. India directly, we don't have much exposure to the Israeli economy. Few companies do have offices there, but they would have business continuity plans. 18,000 odd Indians are working in Israel. But none of that is really moving or shifting our markets. The issue is the geopolitical risk, and will this increase in scope with Russia, China and Iran on one side and US backing Israel on the other side? That is the risk that we are running right now.
So with that in perspective, if oil prices supposedly were to triple here on, what bearing you think themes that one could look at with that in perspective? Sure, from a very economy standpoint of view, it's not going to be a good news given that India is a net importer. But themes that you think could be in focus because of this?
Yeah, it's not like 73 at all, where, oil prices were $2, $4, and they went up to $20. And there was an actual oil embargo by the oil suppliers on the West because of their support to Israel in the 1973 war. So none of those conditions are there today. In fact, most of the Middle East is aligned with the US and the West rather than against them. It's not in the national interest of any of the oil producers to see oil going much above 100, because that will have very strong consequences in terms of bringing the global economy on its knees and destroying demand. So their own budgets will get hurt. Nobody wants that to happen. So I think sane voices will step in. I don't see oil going much above 100. There could be a limited spike in case, suppose Israel shoots a few missiles on Iran, or Iran openly declares that it's at war with Israel in support of the Palestinians. Those kind of things could spoil the sentiment. But otherwise, the major producers are very clear they would not like to go above $100. because then that will really hit demand on a very sustained basis, and their own budgets will come under jeopardy, and it will lead eventually in a 2 to 3 month scenario to a very sharp fall in oil demand and oil prices.
So would you want to stay off companies and the themes which are related to oil right now, something like an oil producer, marketing companies, paint companies? How are you looking at it? What's your allocation going to be like?
So right now it's risk off. So you stay to your allocation right now. Based on this geopolitical risk, there is not much change that's happening. The positions that are being taken off are the leverage positions. Normally, hedge funds would have borrowed money, would be doing carry trades. So there will be a rush into safe havens like gold and dollar and yen and Swiss franc kind of assets. So that leverage portion and the risk-averse short-term portion of global flows will go out. Rest, this is not that big an event right now. As we have seen in the Ukraine event, it was a big surprise for the markets. Then the scale of it surprised markets even further because the previous precedents of 2014, of 1994 in Ukraine had shown that within 3 weeks the markets had bounced back. This time it took a little longer, but still markets had gone up. And of course, the central banks remain on the sidelines that in case conditions tighten too much in the markets, they will intervene. So I'm not seeing a very big issue right now. Of course, the bigger thing remains on the table of an Iranian direct involvement or say an Israel-Iran conflict. Remember, the Israelis were the ones who took out Saddam Hussein's nuclear reactor. And at that time, of course, it was a very different world. We are 30 years later. Today, the Iranians have proxies in terms of Hamas and Hezbollah sitting on the borders of Israel. So they don't need to come in the picture on a full frontal attack. They will stay as a proxy power. So that is what is the concern for the markets, that how big does this spread into. Right now, nobody is cutting positions, and I would not say that you would need to take any investments decisions based on that in India. For Indian investors, it really, the oil is the only thing, and global risk of sentiment if that leads to some FI outflows. Those are the two things, but I would say India remains a buy on dips market. So if our markets have a knee-jerk reaction, we will see domestic money coming in and buying more.
Okay, so allocation doesn't change, and at this point of time, you wouldn't suggest perhaps to take the safety of large caps as compared to mid caps and small caps, which perhaps were doing well until now. Do you see that trend changing anytime soon in the run-up to the event, of course, if it gets bigger than what it is, and also the earnings season?
Yeah, so earnings season-wise, we see automobiles doing well. We see metals mining seeing some amount of turnaround. We are expecting capital goods companies to report very good numbers, and banks and NBFCs to continue the good numbers based on what we have seen. Some of the consumer portion should do well. Durables, we were expecting a turnaround now with the festival season starting in another 5 days. We were really hoping the durables to start picking up, and the inventories have been added by distributors in anticipation. So earnings season, the soft points will be IT, pharma, limited pharma. Still, I think there are issues, and textiles, gems and jewelries, those kind of sectors which have been hurt by the global merchandise exports going down. But the other bigger domestic segments will do very well. Real estate continues to do well. So domestic earnings, we don't see an issue. Flows-wise, we have seen right from mid-August onwards some kind of outflow, net outflow from the Indian markets, which is in keeping with emerging markets losing flows because of a strong dollar. Those conditions are still in place. So a strong dollar is in place. We don't expect those FI flows to reverse in a rush. Globally, it is a risk of for a little more time. But the good news is rates are near to peak. Inflation is on a downward trend. Oil becomes the big joker in the pack. And this geopolitical tension in the Middle East becomes a cause for worry. But having seen it from 48 to now and the market reactions, these are very small economies. Israel is a $500 billion economy. Hardly any impact on the oil market, 300,000 barrels a day of refining capacity, Palestinians having no capacity. So it is more Israel-Iran which becomes an issue. If it's Saudi-Iran, becomes an issue. And the role of Russia and China, given Russia has boots on the ground in Syria, what do they do? But there are saner voices. Turkey will not want a conflagration right now, seeing where it is economically. Biden can do without it, definitely. He was looking like a Camp David kind of success, what Jimmy Carter did in 79 with the Israelis. Biden was looking at a Saudi-Israel handshake to create a good upsurge for himself going into the elections. So nobody behind the curtain wants this to spread. Israelis have to attack because 1,000 people came into their homeland and have massacred their civilians. So for the domestic population, asymmetric attack will be needed. That will come in the form of occupying Gaza again, which they left in 2005. They will occupy it again. But there, it's very asymmetric. It's not two sovereign nations fighting. Israel will be able to bring force onto it. And if we can avoid the spread of it, then markets will again focus back on the higher for longer and the Fed issues and the October 12th US inflation number. I think those will become more important again rather than this geopolitical risk.
All right, one last question, Mr. Bagga. In that case, is your assessment on the impact and the RBI monetary policy development that came in with regards to the sale? Bonds perhaps, slumped to year low level and the yields shot up. Do you see that? Do you see any kind of cascading impact of that development on Indian equity markets? How are you reading into it?
See, we have a fiscal issue. We have stayed above 6% for a very long time. And we have been borrowing a lot, but the government had, transmitted its intention for the second half of this year very clearly. RBI is a central bank which talks very transparently, doesn't believe in shocking the markets at all. I think it was an overreaction, especially if within the next 4 to 5 months we start seeing global dollar bond buying of Indian bonds, global money coming in, then it will ease the situation even further. Right now, the yields are moved up in anticipation that 5 state elections will be announced today. National elections are coming up. There will be more spending on subsidies than has been factored in the budget. So maybe there will be more bond selling on behalf of the government by the RBI. That is what the market has factored in. Otherwise, we see inflation going into the 5.5% print over the next 3 months. We don't see food inflation running away. Government is taking supply side measures. Oil remains the joker, as I said. So oil is with, but the good news on oil is since April last year, government has not allowed retail oil inflation to go up. So they have held the prices. So then you short the refiners at that time because they'll be made to take the losses till the new government comes in next May. The losses will be moved to the oil refining PSU balance sheets rather than burdening the retail consumer. So it was a counterintuitive move based on the governor's statement on bond selling. But I don't know, I don't see it being very sustainable because all the fundamentals are pointing elsewhere.
All right, Ajay, we're going to leave it at that. And thank you for taking out the time to put this in perspective for us.
Thank you. Sorry for talking in paragraphs rather than statements.
No, absolutely, absolutely well explanatory comments coming in from you. Appreciate.
Yes. You were kind enough to let me speak without interrupting. Very rare these days. Thank you.
All right. Just a quick market check in that case. We have recovered some amount of lost ground, 19,550 level. Around that mark coming in for Nifty 50. Still losses to an extent of 0.5%. That remains to be seen if some more recovery comes to for Indian equity markets, which seems to be a bit more resilient as compared to with that of Globe. But with this, it's wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.